Oh, hello there. You're probably looking at me and wondering, what's a mortgage? How do those work? Where does that word even come from? And is this YouTube host going to tell me? Well, you're in luck. I am. Hi everyone, I'm Lindsay Cohen, one of the experts here at Zillow. We are all about making the home buying journey as smooth as possible for you. We tap into our team's expertise to demystify the process, simplify the jargon, so you can feel empowered and confident when you're looking for your next home. Be sure to subscribe for more videos just like this, and as you follow along in this video, you can check out the links, tools, and resources in our description box below. Today, we are breaking down everything you need to know about mortgages. Let's face it, buying a house is a huge deal. And while our goal is to not freak you out, it's likely going to be your biggest purchase ever. And that will probably involve a mortgage. A mortgage is basically a long-term loan from a bank to help you pay for your house. Think of it like a high five from your lender saying, hey, I can't afford this on my own, but let's team up. The word mortgage comes from a 14th century French word meaning dead pledge. Back then, people would exchange property with a promise to pay it back over time. The pledge to repay the debt died when the debt was paid off or when the person couldn't pay anymore. Anyway, today, a mortgage is a type of loan that you use to buy, improve, or maintain real estate when you don't have all the cash up front. You borrow money from a bank and agree to pay it back over a set number of years plus interest. When you're buying a house, you put down a portion of the home's price as a down payment. Your bank, also called your lender, then covers the rest upon purchase. Your home acts as collateral, meaning if you don't keep up with your monthly payments, your lender can take the property. While that might sound a little scary, a mortgage is considered good debt because it helps you build something valuable. Home ownership. Owning something as significant as a house is a sign of financial stability, and managing a mortgage responsibly can show lenders and creditors that you're on top of your finances. If you're curious about how much mortgage you can afford, we offer a calculator that can help shed some light. The Zillow Home Loans Mortgage Calculator lets you easily estimate your monthly mortgage payment, which includes both the principal and interest, plus PMI, property taxes, home insurance, and HOA fees. How does a mortgage work? Today we have it broken down step by step so you can become a mortgage wizard. First, get pre-approved. This part isn't mandatory, but getting pre-approved is kind of like having a superpower. It tells sellers you are a serious buyer, and it shows how much house you can afford. Plus, according to Zillow, 85% of sellers prefer offers from pre-approved buyers, so your odds of getting that special home will likely go up. And you can start this process and get pre-approved through Zillow Home Loans. Step 2, apply for a mortgage. Okay, it's time to get down to business. When you apply for a loan, the lender will check your credit score, your income, and debts by using an automated underwriting system, or AUS, to make sure you're likely to repay the loan. They might also want info on the house you're buying, like the property's appraised value. Step 3, mortgage approved. Congratulations, you've got the green light. You'll get a written commitment detailing the loan terms and costs. You can then review these terms and any conditions you need to meet before closing and making that house your home. Step 4, complete the closing process. This is where things get official. At closing, you'll sign documents like a promissory note and security instrument. Well, what are those, you ask? A promissory note is like a promise to pay. It's a legal paper that explains the details of a loan. A security instrument is a legal document. It lets the lender take your property if you don't repay the loan. Step 5, make on-time payments. You'll make regular mortgage payments until the loan is paid off. Remember, while you own the home, the lender has a stake in it until the mortgage is repaid. So on-time payments are critical here. If you fall too far behind, the lender can take back the house. Yikes. Step 6, build equity. As you make your mortgage payments, you build equity in your home. This means you'll start to own more of the house and the lender will own less. Eventually, you'll pay off the loan and own the house outright. Goodbye, lender. Before you sign any mortgage documents, make sure you understand everything. Here are some key things to look for. 7 things to look for in a mortgage. Loan type. Fixed versus adjustable rate mortgages, or ARM. We'll cover this in a second. Loan amount. Can you afford the monthly payments? Use Zillow's calculators to find out. We're linking below. Interest rate. This is the percentage you pay on the loan amount over the life of the loan. Fees and costs. Make sure you understand all of the associated costs. Repayment schedule. How often will you make payments? Typically, this is monthly. Prepayment penalty. Can you pay off the loan early without a fee? Loan term. This is how long it will take to pay off the loan. Now let's take a closer look at common mortgage options, and we'll define some of the jargon along the way. Types of mortgage loans. There are 2 main types of mortgage loans: conventional and government-backed. Conventional loans are offered by private lenders and are not insured by the government. They can be conforming or non-conforming. Again, what are those? Conforming loans are your classic mortgage. They meet certain standards set by the government, and they usually have lower interest rates and straightforward requirements. But conforming loans only go up to certain amounts. If you want to borrow more, you may need a jumbo loan, which is one type of non-conforming loan. These loans offer more flexibility on the amount or on your eligibility as a borrower, but they might cost you more. Government-backed loans include FHA, VA, and USDA loans. These are insured by the federal government, which makes them more accessible for some borrowers. FHA loans are backed by the Federal Housing Administration. Anybody can apply, but they are popular with first-time homebuyers and those with lower credit scores. The benefits are lower down payment requirements, as low as 3.5%, and more lenient credit qualifications. VA loans are backed by the Department of Veterans Affairs. These are loans available for veterans, active duty military personnel, and eligible surviving spouses. There's competitive interest rates, additional protections for borrowers, and no down payment required. USDA loans are backed by the U.S. Department of Agriculture. Low to moderate income borrowers living in rural or suburban areas are eligible. And for this loan, there's no down payment required. You'll also find low interest rates and assistance for homebuyers. So now that we understand the types of loans, let's talk about interest and fees. Interest on a mortgage. Interest is a percentage of your loan amount that you pay to the lender. Your credit history and economic factors influence it. There are 2 main types for how your loan's interest will work: fixed versus adjustable rate mortgages, or ARM. Fixed rate mortgage. So this is a more steady deal. Your interest rate stays the same throughout the loan term, giving you peace of mind. Adjustable rate mortgage, or ARM. So this is the more flexible option. Your interest rate stays fixed for a certain period, then adjusts based on the market. ARMs often have a lower initial interest rate than a fixed rate mortgage, which can result in lower monthly payments. So this can help folks in the short term if you feel like you might have more financial flexibility in the long term. Lender fees and borrowing costs, or APR. Lenders charge fees and other costs when you finance money, which are reflected in the APR. This includes your interest rate plus any additional costs like mortgage points, origination fees, etc. The APR gives a clearer picture of the true cost of borrowing. Finally, how to pay back your mortgage. A mortgage term is the time you have to repay the loan, usually 15 or 30 years, though terms can range anywhere from 10 to 50 years. Longer terms mean lower monthly payments, but more interest over time. You'll make payments, usually monthly or biweekly, consisting of principal, interest, taxes, and insurance, also called PITI. Some lenders also require mortgage insurance depending on your loan type and down payment. Okay, that is it for today's breakdown of mortgages. Be sure to check out all of the helpful links, tools, and resources in the description box below. If you're thinking about buying a house, leave a comment below with any questions you might still have. And don't forget to subscribe to our Zillow channel so you can see more videos just like this one. Thanks so much for watching.